Hello everyone, welcome to the Board While Waiting show. Just last week, we had Apple earnings and there was excitement over its $110 billion buyback that its stock price shot up nearly 8%. In this episode, I'm going to talk about Apple's growth issues and why the upcoming WWDC event on the 10th of June could be a make or break moment for Apple. Before we get started, a quick recap on the portfolio. The portfolio has gone up by quite a bit because of Mercado Libre's strong earnings last Thursday, and we're currently at 217,841. In an earlier episode, I mentioned that I fired 2 shots into Mercado Libre when it temporarily came down to 1,400 and 1,500. And today I'm reaping the rewards as Melli is above 1,600 currently. And in fact, nearing 1,700. So that's about a 8 to 15% gain for these 2 shots that I fired over just 2 months. So let's get straight into Apple's earnings to kick off this episode. Firstly, in last week's report, the total Q1 revenue for Apple was reported at $90.7 billion. Compared to March last year, Apple's revenue back then was $94.8 billion. So that's about a 4% drop in revenue. So in fact, Apple's revenues are shrinking year on year. That's not a very good sign. During the call, Tim Cook mentions that in March last year, iPhone supply constraints were eased and some of the pent-up December demand went into Q1 last year, causing last year's results to be a bit stronger than expected at $94.8 billion. So he estimates that the impact of this anomaly is about $5 billion. And he says, I quote, "If we remove this from last year's results, our total company revenue this year would have grown. If we take his word for it and we try removing $5 billion from last year's revenue, Tim isn't wrong. Last year's revenue would have gone down to $89.9 billion. And, well, Apple has grown, but that growth is just 1%. So, when the CEO of a company starts using financial engineering or anomalies to obfuscate a weak year-on-year growth, alarm bells start to ring in my head. If we dig deeper into the individual categories, the iPhone has fallen 10.4% year on year. It makes sense that there isn't much iPhone growth recently, since it's purely relying on people replacing older iPhones. And because there hasn't been any large innovation in iPhones, this replacement cycle should get longer and longer over time. Which is quite worrying given that the iPhone takes up 52% of total revenue. So a persistent fall in iPhone sales would continue to move the needle in the wrong direction. The iPad also didn't fare as well. It declined 16.7%, along with wearables at minus 9.6%. So only the MacBook out of all the hardware products did okay with 3.9% year on year. But overall, we can see for all the hardware, it just isn't doing that well for Apple as a whole. And that accounts for 80% of Apple's business. One category that, of course, performed really well is services, because Apple has such a large base of users and most people don't leave the Apple ecosystem, even if they don't replace their devices. So as a result, services still continue to grow at strong double-digit numbers. If we take a look at the regional split of revenues, we can see that the Greater China region sales, that was once a great engine of growth for Apple, has dipped by actually 8.8% year on year. If we contrast that to news like this, for example, in the same period where Huawei surged by 564%, we can see that Apple is starting to lose some growth momentum in the region. It also doesn't help that the latest Vision Pro has actually been disappointing. It was initially expected to sell 800,000 units this year, but Apple has slashed this forecast by 50%. And the point I'm trying to make is that the overall data for Apple just doesn't look that great, especially on the hardware side of things that is a majority of their revenues. And there isn't any clear picture of what the next growth driver is for Apple. So despite all this negative trending data and the lack of a solid growth plan, Apple announces a $110 billion historic buyback which makes it the largest buyback in US history. And this of course sent Apple shares flying 8% last Friday. And the consensus is that Apple has been performing buybacks every year, so this is nothing out of the ordinary. And the positive reaction was, well, justified. The problem I have with this argument is that buybacks are only a good use of capital if the business is growing fast and the valuation of the company is cheap. I dug through data of the past 8 buybacks of Apple, and we can see that in the earlier years before 2020, they did buybacks when the PE ratio of the company was below 20, which is the green line that you see that I've plotted here on this chart. Now that was a great use of capital back then because the business was growing fast and the valuations were cheap. So it was great value for the company to buy back its own shares and return capital to shareholders at those points in time. Now the issue with this recent $110 billion buyback is that this time, the PE ratio of Apple is in fact above 25, and the business isn't growing as fast as it used to, as I described earlier on. So Apple is basically saying that they've run out of ideas on how to use capital to expand their business. So let's just return it to shareholders to buy some time. And well, the way Tim Cook tried so hard to explain a fall in revenue with the $5 billion anomaly just reaffirms the fact that the short to medium term growth of Apple just isn't looking too good. Because if your growth is so strong, you wouldn't even bother explaining an inconsequential shortfall to that level of emphasis. So to me, this buyback feels more like a distraction until they reveal their next growth strategy. Which brings me to the important point of this episode. During the earnings call, Tim Cook mentions that he can't wait to reveal what Apple has in store for next month's WWDC, or short for Worldwide Developers Conference, which falls on the 10th of June. I quote, "We continue to feel very bullish about our opportunity in generative AI. We are making significant investments and look forward to sharing some very exciting things with our customers soon. We believe in the transformative power and promise of AI, and we believe we have advantages that will differentiate us in this new era." Those are some pretty big words he's using. Very bullish, significant investments, transformative power, new era. He has every reason to bet big on this next initiative. Well, because even Berkshire has just announced that they are cutting 13% of their Apple stake. I know before anyone talks about the tax portion, I just want to put it out there that I don't recall Buffett ever selling Coke or American Express for open inverted commas tax-related reasons. So there's obviously more than meets the eye. And in any case, Tim Cook has to come up with something big that can move the needle to the same level as the iPhone, or it risks losing its momentum as a growth tech stock. But what could this huge bet be? If we look across the business segments of Apple, the green bar represents services, and it is the second largest part of the business at about 20%. So it's been growing strongly over the last few years, and during the recent earnings call, as mentioned earlier on, it was the only segment that could post double-digit growth in the whole company. And because Apple has 2.2 billion active Apple devices, it may not have much more room to sell more hardware, but it does have tremendous opportunity to sell more software-related services or subscriptions to this existing 2.2 billion user base. So I think personally that this next big chapter of Apple has to somewhat relate to their services sector. If we go back to the statement Tim Cook made earlier on generative AI in the announcement at WWDC, we can sort of connect the dots with services because he does mention services integration as part of the big AI announcement for this upcoming event. What kind of AI announcement would make sense at Apple's WWDC events, and how would it increase service revenue to be on par with iPhone revenue? There has been a lot of rumors going on in the market that Siri will likely receive an upgrade on iOS, and it could perform some sort of generative AI actions such as summarizing text or web pages. The problem I have with this rumor is that I don't see how that makes Apple enough revenue that could move the needle in the short to medium term. One prediction I've heard is from someone called Ben Reitz, I hope I pronounced his name correctly, from Malayas Research's Head of Technology, where he believes that the upcoming announcement involves a new AI app store. So I actually thought about it and I thought it actually made a lot of sense, because if we take a look at the revenue breakdown of the services category, which by the way, Apple doesn't actually provide a public disclosure of this breakdown, but there were some old estimates of this back in 2020, which put obviously the App Store alongside the licensing fees. Licensing fees are, for example, the fees that Google pays Apple just to be a default search engine. So estimates have put the App Store revenue and the licensing fees at the top. And I feel like this is a good possibility of what's going to happen, because having sort of like an AI store for Siri would be like what ChatGPT has done with its GPT AI App Store. And if Apple could pull off something similar, this could have a very large impact on Apple's top-line revenues and could be its next big growth story. In a previous episode, I did talk about AI agents when I mentioned Meta's business messaging opportunity, and I see a similar agent-like workflow. So with Siri, for example, it could be the case where an upgraded version of Siri comes out, and then, for example, if let's say I'm using it and I say, "Hey Siri, could you book me a taxi home?" So Siri listens to me, responds with a LLM model, which is likely to be Gemini based on recent announcements, and then Siri automatically makes a taxi booking for me on an app like maybe Uber. So all I need to do is press confirm. And the idea is that apps like Uber would begin listing AI versions of their app in a Siri ecosystem. So I'm going to make a prediction that at this WWDC, the AI announcement will involve an upgrade of Siri and an opening up of some sort of an AI app ecosystem, where in the future, Apple will be able to charge some form of AI listing fees. The second prediction I have for WWDC is that Apple will likely release more details on its next generation chips that will likely power future generations of the iPhone. So in the short term, a lot of the generative AI inference would likely be powered by the cloud through partnerships such as Google's Gemini. But over time, because Apple has such a large focus on privacy, I believe there will be a future upgraded iPhone that has enough capabilities to support local LLM requests at low latency. So this should then power the next phase of Apple's iPhone hardware sales. Again, these are all predictions and no one can know for certain what exactly is going to happen. So having analyzed the earnings call and having had a sense of what's to come for WWDC, how exactly am I positioning the portfolio for an investment in Apple? For full disclosure, Apple is indeed in my watch list for the long term, because I believe that the Apple ecosystem will continue to thrive for many years to come. The only problem I have is that Apple's slow growth doesn't justify its current high valuations. There are two options I will be waiting for. The first option is to wait specifically for the 10th June WWDC announcement to see if there is indeed a significant next growth story for Apple to justify today's prices. If the WWDC announcement doesn't have the same level of impact as, for example, an AI app ecosystem I predicted, and only involves some kind of simple upgraded Siri, that can just summarize text or perform mundane Gen AI image or text capabilities, I would be quite disappointed. I wouldn't consider buying into Apple at today's prices. The second option is that even if the 10th of June announcements are not up to expectations, I will wait for a decline of at least 25% from the all-time highs, which would mean I'm looking at a price of about 150, which is the blue line I've drawn on this chart. And as you can see, it is a long way down. And the reason for a specific 25% drop for this is because remember in the mathematics of gains versus losses, a 25% loss means about a 33.33% gain. And for a lower growth stock like Apple, I prefer to have at least the potential to achieve a 30% gain as a sort of margin of safety. So for faster growing stocks, I'm a bit more flexible in the percentage decrease bargain I'm looking for before I buy in, because I know in the long term, the stocks that move faster should gain back a 30% hurdle rate at a much faster rate. And furthermore, in Apple's case, the 150 price level is a conservative discounted cash flow intrinsic value that I've calculated. And it also happens to sit on a support and resistance line. So yep, that's about sums up the plan that I have waiting for Apple specifically. And I hope you enjoyed this episode. I'll see you in the next one.